Hey, Walter here, and I want to talk about getting stopped out. And when you get stopped out of a trade, sometimes people get a bit upset, or they think, "Oh, what did I do wrong?" And they try and reassess the situation. And in that way, it's kind of like going through a breakup. Sorry about my voice; I lost my voice here. Uh, I think this will be the last video I do today, but I just wanted to, draw the parallel because it is true. You learn things from relationships you had, whether it's a romantic one or just a friend or whatever that you don't talk to anymore. You can go back and think about the things that you've learned. And a lot of times we want to do that as traders. There's a real temptation there to do that. Now I'm in this trade. This was a sell on this pair, the pound yen, way up here, and it's down here now, and you can see I've got this stop loss running. All the other, I took three, but all the other positions have been closed out, and now this is the final one. This is the final position here that's going to get, probably going to get stopped out pretty soon. It's pretty close to the stop loss. It's currently in 71 bucks of profit. And by the way, if you want to learn more about these trading accounts, you can go to bigprofitscourse.com or click the link below this video, and we'll show you all about the course. We're taking $1,000 and ramping up to 100 grand over the next 300 trades. Now, I don't mind getting stopped out, but I will share with you a couple of different things that you can do to help. And actually, there's another trade on the other account here. This is the same. Well, this was late. This was a later trade taken off these candles here. On the same pair. The original trade I showed you on the other one was up here. But this is the 4-hour chart. The other one was the 6-hour chart. Basically, this one's going to get stopped out. It's got the same price, the same stop loss. And I'm not going to be upset about that. I'm not going to be upset about the fact that, there it is. See, you can see it's going to happen right now. That it went as low as down here, but that I had to give back whatever that is, 98 pips, something like that. Yeah, had to give back 98 pips on this move, on this retracement, because the payoff is by using a trailing exit, I have an unlimited possibility for profit. Like it could literally go thousands and thousands of pips in my favor. Now, is that going to happen every time? No. Is it likely? No. But occasionally you'll get some really big winners like this one. And the risk on this trade was something like 10 bucks. So 10 bucks is going to make 50 or 48 or whatever it is. And then 10 bucks on this one is going to make, if it gets stopped out now, 60 or whatever it is. Yeah, 69, almost 70. So this is the fun part of getting stopped out. Now, the interesting thing is most trailing exits are going to get you out of a trade when it does the retrace. See how the retrace move here has gone up like that? So the market was falling down, then it did this really, especially this last candle, a really big, bold, bullish candle, and then it fell. And again, we get another big move here. It's always on the retraces that you get stopped out on a trailing exit, right? Well, here's one exit that won't do that for you. There's another. I'm using exits based on the price action of the market, or at least in this case, I am. Now, normally I have a mix of exits. So, but those other ones have been closed out. This is the last one. And so if it retraces really hard, it'll pop this trade out. But you can actually use an R-based exit. And I'll show you what it looks like. So an R-based exit, R is just from Van Tharp. It's this idea that R is the amount at risk. And so you could use a trailing exit where you're basically allowing yourself a certain amount of profit, and as it goes in your favor, you keep moving it down, just like a normal trailing exit. But it actually doesn't matter how the market looks when it's doing it. So let me give you an example here so you can see, because that's probably the easiest way to see this. So let's say, in this case, I sold right here, or you sold right here on this little move down, it retraced up, printed a wiki candle here, and you sold. So you've got your stop loss up here, and you've got your entry price down here, we'll say, the blue one. Okay, so whatever that is, that's that total move there is whatever that is. We'll call it 30 pip. It's like 25 pips, really. So now what happens is if it moves 25 pips in my favor down here, what do? Stop loss goes to break even. It goes another 25 pips in my favor. What do? Stop loss goes to 1R. So what it's doing here is it's trailing as the market moves in my favor. And it actually doesn't matter what it looks like when it retraces, as long as it doesn't get, obviously, to the stop loss price. So this is a very different type of exit. A lot of traders don't or won't trade these because they don't really think of their exits in these terms. But in this case, we'd still be in the trade, and it would probably be down around here where we would get stopped out in this case. So it would have been great. And obviously hindsight's great and all that, and it's brilliant. But you can see here, probably once it moves down here, the exit goes here, and then you're stopped out probably on this candle or that one. So let's say that we were stopped out right here. We would have had something along the lines of 10 times the risk. And that's the real advantage of using trailing exits. When you use trailing exits, you can simply take huge wins occasionally. And that's oftentimes all you need to cancel out all those losers and leave yourself with a little bit of profit there in the end. So when you're thinking about trailing exits, imagine, like, what you want to concern yourself with is, where's the weak spot here? Every system has a weak spot. Every exit has a weak spot. And the weak spot with most trailing exits is that if the market doesn't retrace in a particular manner, usually if it retraces in a little bit of a weird pattern, it'll pop you out of the trade. That's not the case with the R-based exit. And obviously you don't have to just move at 1R. There's lots of things. You can wait for it to go 3R before you move to break even. And then when it goes to 6R, you move it to 3R or whatever. There's lots of different ways to change your stop placement. The most important thing, though, to keep in mind is that a trailing exit will allow you unlimited profit. The market can literally go and go and go, and you can capture all of that. Whereas when you put a target in, you've cut off your profit. You've said, I am only willing to profit this much. So that's the advantage of the trailing exit. And this is the advantage of the R-based trailing exit. I hope this helps. If you'd like more information about how we're using these exits to build up our small account or $1,000 account up to 100 grand, you can go to bigprofitscourse.com or click the link below this video and get all the information you need. Until the next video, I wish you happy trading. We'll see you soon. Bye.